Tesla stock has had 6 days in a row of red. That probably ends here shortly because the Fed is, well, about to pivot in their purchasing of securities and they're rolling off of their balance sheet. Yeah, what the Fed just said on this Saturday afternoon is shocking. This likely helps to reverse some of the downside move that we've seen so far in 2024. We'll explain why that is and what's important about this. Not to mention that CPI will be coming out next week, and I'll go over my expectations for that. If CPI comes in good and inflation's falling faster than expected, I would almost, although I can't guarantee, but almost guarantee this stock's turn around some of this latest down move. Here in this video, we will also look at 3 different hedge fund institutional or analysts that have some interesting things to say. We're going to look at Tom Lee with Fundstrat, what he thinks about the first 4 trading days of 2024 being brutal. This other individual believes we've already seen the recession, that good things could be ahead of us. And this other woman is just flat out bullish on our markets. I don't know any other way to put it. I did take the liberty of speeding these up a little bit so you don't have to sit and listen through blank kind of talking for a while. Last but not least, we will go over my expectations for Tesla stock and what I think all of this means for Tesla. Hit that like button and subscribe to the channel. I don't care if you tap, tickle, touch, or smash it, lick it. I don't give a crap what you do. Get nasty with it if that's what you like. But make it turn a different color and let's get started. So this is big news. Fed Logan says today that the Fed should begin discussion on slowing its asset runoff. So basically how this works is the Fed has assets, right? They've bought a lot of assets during COVID times, and now they're in the process of letting those run off. So they buy 1-year treasuries, 2-year treasuries. They really focus on the short end of the curve, 3 months, 6 months, 1 year, 2 year, even up to 5 years. And that somewhat controls the short end of the curve. That's what the Fed was doing during 2020 and 2021. They were trying to keep rates low. Well, when those bonds come to maturity, well, a portion of them gets rolled off and a portion of them gets reinvested. So this article is a fascinating one. It's from September 19th, 2022. It says, this Federal Reserve policy you've never heard of could have the biggest effect on your wallet. They say over the 3-month period, this is when the Fed started rolling off their balance sheet, the Fed was letting $47.5 billion worth of assets every 30 days roll off its massive near $9 trillion bond portfolio, more formally known as the balance sheet. But starting in September of 2022, the Fed kicked up the process a notch, doubling how many Treasury and mortgage-backed securities it's rolling off its $95 billion balance sheet. And this has a huge influence on how much you will pay to borrow money. The Fed raising rates technically is only applicable to bank-on-bank lending. It really has nothing to do with treasuries. It really has nothing to do with anything else. Say JP Morgan has $1 billion. Well, they have to lend it to another bank at the Fed's set rate. That's basically how it works. So then treasuries, other competing asset classes for capital, for investments, well, they go kind of alongside where Fed policy is, especially your near-term treasuries. Basically, in an essence, if the Fed's runoff is $90 billion and they start to reduce that to 70 or 50, whatever the number ultimately is, that's going to be a 20 to 40 billion stimulus, if you will, to help lower rates or to keep rates lower. That's great news because a lot of the stocks we invest in, a stock like a Tesla, small mid-cap stocks, well, they're heavily influenced by the Fed's balance sheet, and historically the markets have been, broadly speaking, as well. If you take a look at the Fed's balance sheet, it was pretty much nothing. It was, pretty minimal, less than $1 trillion before 07, 08. That's where things really kicked up a notch to about $2 trillion. And it's been off to the races ever since. Well, during periods of the Fed's balance sheet rising, you have seen impressive returns in markets. Think about this period from 2012 through 2014. The course of those 2 years alone, the S&P 500 returned about 80%. This was during a time in which the Fed's balance sheet went from $2.8 trillion to about $4.5 trillion. Same is true when the Fed is running off their balance sheet. Back in 2018 through the middle of 2019. During this whole period of time, from here to here, markets did nothing. Literally nothing. You barely reached a new all-time high in 2 years with two massive, this one was 20% of a sell-off. This one was about 15% of a sell-off. Two pretty massive pullbacks. And ultimately, stocks went nowhere. That was as the balance sheet went from about $4.5 trillion down to $3.7 trillion. And then we know 2020, the big increase in the balance sheet from $4 trillion to $7 trillion, basically within the course of a month. And then the subsequent buying from the Fed all the way through the beginning of 2022, well, sent the balance sheet up to $9 trillion, and it also sent stocks soaring as well. What happened following that? The balance sheet has been getting run off. Besides the banking crisis period you've seen where the balance sheet increased about $400 billion, besides that, the balance sheet's been falling consistently. And you might be asking or wondering, if that theory is correct, when the balance sheet falls, stocks fall. When the balance sheet rises, stocks rise. How can you say that when the S&P is near all-time highs? It's because it's market weighted. See, Magnificent 7 stocks that control over 30% of the index in the S&P, well, they've done well because money has been concentrated in those names. Because if you go into a recession, if you have turbulent times in the economy, those are the names you would want to be in. Those companies could still grow and might actually benefit from a slightly recessionary environment. So the index has done well. If you look at something like IWM, which I think is a much better representation of the broader markets, it hasn't done well at all. Hasn't done anything. It's almost unchanged from pre-Rona. I mean, you have a little bit of a gain, but back in November, you were literally unchanged from 2020 or even 2018. So the point is, your average stock has not done much. This is because the balance sheet and that specific Fed policy of running off the balance sheet or adding to the balance sheet has a big implication of how much money goes into the markets. We've really just seen a market that is starved of capital at this moment in time. Well, what Fed Logan just said could spark a much broader market rally. Logan said it's now, quote, appropriate to begin discussing the parameters around a Fed decision to slow the pace of its balance sheet runoff. Quote, in my view, we should slow the pace of our runoff as on-RRP balances approach a low level, Logan said Saturday in prepared remarks for an event in San Antonio. Normalizing the balance sheet more slowly can actually help to get a more efficient balance sheet in the long run by smoothingly redistribution and reducing the likelihood that we'd have to stop prematurely. So what she's actually referencing is reverse repurchase agreement markets. So you were at $1 trillion or $2 trillion, $1 trillion plus for years now, since 2021. And now you're down to less than 700 billion. Last Friday auction we had on Friday, January 5th, you had 694 billion in reverse repurchase agreement market. So this is basically excess capital from the banks. So as the Fed has really been winding down their balance sheets, the banks have been the one that has been picking up the slack of the extra treasuries that are getting run off and being sold by the Federal Reserve. If this starts to get too low, then I mean, the Fed could become the major seller and we might not have a major buyer of treasuries. That would be a big problem. So I don't think this is something that is a choice from the Fed. I think they ultimately need to slow the pace of balance sheet reduction. overall, this could start to give a pretty big boost to stocks like Tesla and really your broad markets. I don't think Magnificent Seven names are going to benefit from this too much because they already have a lot of capital, but I do think a broadening out of this market would make a lot of sense if the Fed does indeed start to reduce the amount in which they are rolling off of their balance sheet. Now let's go ahead and run these clips and come back to discuss what all of this means for Tesla stock.
Wavering at all by virtue of what's going on this week?
We're not wavering, but it's clearly not a good start to the year. I mean, markets almost got to an all-time high at the end of last year, and the first 4 trading days of this year have been really terrible. I can see what the market's struggling with because, as your guest previously talked about, part of it is when the Fed cuts, and I think people are still jumpy about a strong labor market and if inflation is happening. But our base case still remains that, we're going to see all-time highs in January, and then I think the market is tough in the first half of this year because of some of those things, but we'll overall end up strong by the end of the year.
But you're not rethinking your own outlook at all by, how, you obviously sound somewhat concerned by the way this year has started. Maybe it didn't go according to your plan. So how's that all factoring into your psyche?
Well, yeah, I think it is disappointing because, the year tends to play out in January. So the fact that we're, sort of had a failed Santa Claus rally in the first 5 days is pretty important, and the market looks like it's going to be negative, just tells you that the fundamentals, which have been improving, aren't necessarily going to convince investors to be buying stock. So I do think it's telling us it's going to be a tough year. But the reason we're not wavering is that the reasons we think 2024 will be a good year for stocks has to do with the fact that the PMIs are bottoming and inflation's falling like a rock, and the Fed has pivoted and is now managing a business cycle. Those are really good anchors and supports for why stocks can do well, but it's not a great start. It'd be much better if we were up for the week.
Yeah, well, bulls would feel better. What about this ISM services report? I know you talk about PMIs, but is that concerning to you?
Well, it's there's pluses and minuses. To me, I think the ISM services employment number and, the manufacturing number show you that the labor report we got today may not be as strong as it looks. And I think that's actually good because we don't want a labor market showing signs of rejuvenation. I think the trend there is sort of softer employment growth. And from a prices perspective, I think it's pretty supportive of what we've been seeing, which is, prices are falling. And as long as housing and cars don't surge, housing growing at 3% is fine. That's consistent with 2% inflation. I think inflation is going to eventually be viewed as, approaching target. And that's actually good. So, Scott, the data isn't always in a straight line. I think it's a little messy this week, and I think it is disappointing to see. But I think too many are going to be quickly turning bearish and then put on their hard landing or skeptic hat or the Fed hawk hat. And I think that's going to prove to be a mistake.
Track to close the first trading week of the year with 4 consecutive down days, and that could be bad news. The Stock Traders Almanac warns the first 5 trading days aren't open for the rest of the year, but my next guest is a little more optimistic and, in fact, says he's rarely seen this many good investment opportunities. Here with me now is Steve Auth, the Chief Investment Officer of Equities at Federated Hermes. It's great to have you here. Welcome.
Likewise, Kelly.
Especially because your mood is so different from a lot of the, okay, maybe it's not as different right now. We've seen a lot of optimism around the turn of the year, but you're saying you really see a lot of opportunities out there, even with stocks near all-time highs.
Yeah, we're the broader market, Kelly. We're thinking 5,200 as our target for the end of the year, so it's not heroic, probably single-digit return kind of market. Maybe we're setting up for 10% off of current levels. But we think the excitement is underneath because obviously most of the return in the market last year, well known, was the Magnificent Seven, and everything else didn't do much. And now there's so many stocks out there that are still 10, 20, 30, even 50% off their old highs. As we break through, if you get into an economic situation like you've been discussing that's not a big recession, we think it kind of happened already in an asynchronous way.
You think it happened already?
Yeah.
This kind of series of, as we've talked with others, or Steve Leeson, about rolling recessions or mini recessions. Look at the ISM manufacturing, 15 months negative, that kind of thing.
Right. Our rocky landing idea that we were going through an asynchronous recession for the last 18 months, chips, housing, commercial real estate, the regional banks, et cetera. And I think we were going to look back and say, gee, the recession already happened. So once you get to that point, then all these stocks, these higher risk stocks, smaller cap stocks, value stocks, cyclical stocks, emerging market stocks that have been held back because the recession is about to happen, and the date of it keeps getting pushed away.
Right, and you were optimistic all of this year, and the market and the facts have come around to that point of view. So you think it's kind of, we can keep going, even where we are. And you have some names here.
To our talk of the tape, the slow start to 2024 and what lies ahead with some critical data and earnings looming next week. It's all coming fast. Let's welcome in Courtney Garcia, Payne Capital Management Senior Wealth Advisor, with me here at Post 9. Happy New Year. Welcome back.
Happy New Year. Thanks for having me.
So what's your big takeaway from the way this year has started?
The big takeaway is what we saw in October, where everything rotated, right, out of the Magnificent Seven that was the place to be in the early 2023. Everything has shifted now, and you're seeing your interest rate sensitive things like small caps, real estate, energy are actually all starting to outperform. And I think that's only going to continue as we look into 2024. And that's where you're seeing some of the euphoria with artificial intelligence is going away. People really want to see that actually reflected in earnings. And I think things are going to go back to fundamentals, and that's where you want to look at some of those value opportunities.
I mean, it's not like you've had, a ton of money coming out of mega caps and going into the Russell. I mean, it's been a pretty equal opportunity sell-off. I mean, the NASDAQ and the Russell both are down about the same on the week, each more than 3%. So what is that telling us?
And I don't think we want to too much extrapolate from this 1 week. I think really if you go back the last 2 months, I think that's actually going to show a stronger picture here. And some of that is you're going to get, people are just taking profits across the board right now because it's kind of interesting. But the investor sentiment levels have been overly optimistic. Yet at the same time, and we're seeing this with our clients, people are still very cautious and they're keeping their cash on the sidelines. If you look at cash levels, the end of that last week of December, cash levels actually went up. Meaning even though people they're optimistic with the markets, people think the interest rates are coming down, they're still keeping their money in cash. I mean, they're not actually ready to get in the markets. They're not actually believing that those money market rates are going to go down. And it's not necessarily what we're advising, but you're definitely seeing that right now.
But does that mean that, some of that next leg is going to be a bit muted because there's just not enough cash, new money coming in?
I would actually say that still leads to an opportunity because that money can still lead its way in. I think people aren't overly optimistic. They're not throwing all their money into the markets. You're not seeing that euphoria. I actually think that could lead to a further upward trend.
You sound like you're a believer in the idea, though, of that rotation being longer lasting. Money coming out of mega cap winners and going into other unloved areas or small caps or what have you.
Absolutely. We're actively talking to our clients to that about right now because if you didn't rebalance your account so far, you're going to be overweight in technology in those 7 companies. And especially, I have a lot of people who say, oh, no, I've got an S&P 500 fund and a total market fund. I'm good. You have no idea that about 30% of that is those 7 companies. And if you haven't made a change in your portfolio, you're going to want to take some of those profits and add to other areas. I'm not getting out of the Magnificent Seven. I just want to take some profits there and take some better opportunities.
What if it's a giant head fake, though? I look at that ISM services today and I say that's the one thing that you cannot have deteriorate. Mm-hmm. This whole notion that, even Janet Yellen, the Treasury Secretary today, said in an interview that we can describe what we're seeing now as a soft landing. And my hope is that it continues. But what if the economy continues to soften a bit more than it is now? Still stays out of recession, but continues to be a little bit weak. Doesn't that take some of the oomph off of those other more cyclical and small cap areas of the market?
Not necessarily, because we need the economy to soften to a certain extent so that interest rates do in fact come down, right? Expectations are there, but we need a softening for inflation to continue to come down. It's just we don't want to soften so much we go into recession, right? So it's that kind of perfect scenario that we need to get into. And I think that's what you saw with the jobs numbers today. It was kind of bringing into reality the fact that, yes, the economy is softening, but we still have a really strong labor market. And I think when people are expecting those 6 to 7 rate cuts next year, they're probably getting a little overly optimistic. I think rates are probably still coming down, just maybe not as much as people had gotten excited about in the last 2 months. And it's probably going to be a little longer.
I'm sorry to interrupt you there. I don't know many people, if any, that are expecting the kind of year that we just had to be backed up in terms of performance out of the S&P 24% or whatever. But what's in your mind as to what seems realistic for the S&P? Mid single digits, high single digits, low teens? What sounds reasonable to you?
When you have a year like last year where the markets were up double digits like they were, you actually tend to have like a mid single digit year next year, but again, in the upwards direction. So I think odds are on your favor that we'll continue to have a positive year. We're going into an election year. I think things are actually, especially as interest rates come down, leading up well to that. So yeah, I don't know if it's going to be the same kind of outperformance last year, but specifically the companies who did outperform as much as they did, I don't think that's where the performance is going to come from. And that's what you need to be aware of.
But you think it's coming from the laggards, the healthcares, the small energies, caps, we mentioned small caps. Well, why healthcare and energy?
Both of those are actually going to be beneficiaries of, well, specifically healthcare is actually going to be a beneficiary of lower interest rates, right? I mean, you're going to see more M&A activity. You're going to see as they need to borrow more money, it's going to become more feasible for them. So I think you're going to see a lot of that as we go into 2024.
First and foremost, in this upcoming week, we are going to get inflation data. Now, core inflation month over month is expected at 0.2%. Last month was 0.3%, so that would be great news. Core year over year is expected at 3.9%. Last month was 4%. So if core year over year can fall lower than that, that would be really, really good news, especially for a lot of the algorithms, a lot of the trading programs out there. A lot of them are really fixated on year over year inflation when month over month in reality matters the most. For whatever reason, year over year tends to give the markets the bigger reaction. Your headline inflation rate month over month is expected at 0.2%. That would actually be a slight uptick from 0.1% last month. And your inflation rate year over year for December is actually expected to rise from 3.1% to 3.2%. I think these expectations are far too high. I think 0.1% core is likely. I think 3.7 or lower year over year core is likely. I think month over month headline is going to come in at 0.1, maybe even potentially negative. I think that's way off as well. And year over year inflation expected to rise. I don't think that's going to happen either. So the expectations right now are pretty dang high. You would have to see, in my opinion, a terrible inflation report, like something that is far off of my expectations or my radar, to see the markets actually sell down based on this inflation report, because expectations are already high. If you're going into a report with high expectations, even if the report's not super stellar, you're still better than expectations compared to the contrary. If there's really low expectations for inflation, let's say these numbers were 0.1% on the core or 2.9% on the year over year headline, then it's a lot harder to beat that number to the downside. So I think CPI this upcoming Thursday on January 11th, probably going to be a very bullish event for the markets as well. If markets do get excited about the Fed potentially reducing the size of the runoff of their balance sheet, which I think is appropriate right now, given they almost have to start reducing their 90 billion a month down to something probably like 30 billion a month would be my estimates, maybe 20 billion. That's going to be a big stimulus boost, if you will, to the broader markets. Mix that with CPI coming in better than expected on Thursday, and I think Tom Lee's probably correct. We could see new all-time highs in the markets in January. And as he also said, January tends to dictate the rest of the year. So if January is really bad, the rest of the year tends to be not so great. So if we can actually get another rally here in January, which keep in mind, we've only had 4 trading days. It is January 6th at the time of recording this video. There's a lot of time left in January to see things turn around. If that does indeed happen, that's going to be great news. And like that other individual mentioned, the data has likely supported we've been in a recession for a long time now. And like Tom Lee said, the data of last week was pretty mixed. There was some really bad things like ISM services employment just plummeted. I mean, look at the services employment. Anytime you plummet like this, you're either in a recession or very close to one. I think this does indeed be a key reason why the markets continue to price in many rate cuts, continue to price in the first rate cut in March. It seems like the Fed really doesn't have a choice. But again, I will reiterate, if we go into a recession, Tesla stock will not do well. If we avoid a recession, even if it's slippery, slopey, kind of, who knows, markets get jumpy, then I think Tesla stock will perform very well by the end of the year. And you could probably see a near-term rally in the markets. And that would really just be based on my expectations of lower CPI and the markets getting even more excited about the Fed reducing their balance sheet runoff. Let me know what you think about all of this information down below in the comments section. What do you think is coming next for Tesla stock? Personally, I do think we will get a bounce in this demand zone in the 230s and likely start to make our way back into the 250s, 260s, or even into the 270s by the end of January. I do believe as long as we don't continue to get recessionary data, the markets will start to form a different narrative that if the Fed can start cutting rates in March and the economy is not in this recession, we might outright avoid it because of the Fed cutting rates. The Fed might be just on time. That could start to develop to be the market's narrative. We'll obviously have to wait and see, but I am hopefully optimistic for January. Especially we have an Indian factory that may or may not be getting announced in January. Potential FSD entering the Chinese market in January, maybe February. And we do solidly have Tesla earnings on January 24th, in which I think we're going to get some exciting news there as well. So again, let me know what you think about all of this information down below in the comment section. The good thing is, as long as nothing crazy happens, Tesla stock's probably going to stay in the 230s, even if, bad things happen. There's a lot of demand in this 230 zone. If you break under that, then you're falling back to about 220. But I think your downside here is pretty limited, whereas your upside is exponential. Thank you for watching. If you guys want to come trade with us live in real time, link down below in the description of this video. We had a great 2023. Hopefully, we will have a great 2024 as well. We know one thing for sure. It will be a volatile year, especially as we have elections, Fed rate cuts. Oh my gosh, you better get ready. Maybe take some time off. Maybe take a couple days to get ready for all the stress that you might potentially experience. It's going to be a lot of volatility. So, my name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.